Just this past week, the European Central Bank agreed to start its own quantitative easing program, announcing that it would purchase 60 billion euros a month of European government bonds for more than a year. Now, for those of you trading in U.S. dollars, that's around 70 billion a month equivalency at today's exchange rates, although the U.S. greenback is gaining strongly against the euro, as the U.S. Central Bank has recently done the opposite. They've just stopped printing money, and they've even thrown out the idea of raising interest rates and thus the dollar's value later in 2015. But what does this really mean? How does this translate into the real world for you and me? Well, let's take a look at this on this Safe Insight for January 23rd, 2015. There are several things that need to be understood, and this Safe Insight will try to bring them down to earth. The first issue is, why is this happening? Why is the European Central Bank following in the footsteps of its big brother, the U.S. Federal Reserve? The reason simply is that Europe's economy is stagnant. The oil price decline has powerfully impacted the Russian economy, and as continental Europe trades heavily with Russia, the economic slowdown in Russia translates directly into an economic slowdown in Europe. Secondly, some members of the European Union haven't exactly handled their government budgets responsibly, and nations like Greece are in a free fall. These things taken together, as well as a U.S. dollar that's rising in value against the euro, making imports to Europe more expensive, has caused Europe to slow down a lot. So as central bankers do, they're looking to stimulate, and rather than governments cutting taxes, which puts more money into the hands of consumers, they stimulate by printing money. The fear and the opportunity of this action by the European Central Bank is real. First, currency traders will make significant returns buying the U.S. dollar and shorting the euro. That's a relatively obvious one. Second, this will continue to see outcomes driven by Switzerland's response of taking their Swiss franc off of its pegging to the euro. Now that sounds complicated, but it's not. Unlike other European countries, Switzerland still maintains its own currency, but it has historically agreed to peg the value of the Swiss franc to the euro, thus making them equivalent. However, this loose money policy by the European Central Bank has caused the Swiss to unlink their currency, the Swiss franc, from the euro, thus shooting up the value of the franc and lowering the value of the euro. The direct impact that scares people, and this is translated into a volatile U.S. market so far in 2015, is that Europe, a huge economy, could be entering a period of stagnation and deflation, kind of like Japan's lost decade. The problem is the central bank can print all the money it wants, but if businesses and consumers don't spend it, it just sits there and makes things cheaper, which in turn makes people want to wait to spend their money, as prices will be seen to be cheaper in the future, which in turn slows things down more, thus reducing future prices, which in turn causes people, well, you get the point. Deflationary cycles are bad, and that is why the stock market is fearful. The debt building in European governments is very similar to the debt built in the American government. It's significant, and the way to get out of that position is to reinforce economic growth. And the way to do that is to lower regulation, lower taxes, and incentivize people to act in their own rational self-interest, which, yes, will lead to economic growth, not stagnation. But the Europeans are still trying to print money to get them out of that problem, and that, A, will not solve the problem, and B, will continue Europe in its stagnant deflationary cycle. Couple of investment ideas for you: UUP and EUO, two ETFs that directly put you in the driver's seat on currency fluctuations.